Well, good afternoon, everybody. Welcome to the November edition of Market Insights. We're winding the year down, last 2 months of the year. It's been a busy, busy fall, lots going on, be it markets, political, all kinds of things going on. Before we get started, let's hear from the legal team.
International airline reserves the right to limit access to airport property.
All right.
Only
How you doing, Todd?
Good, I'm good, Gavin, and we can see Rich is at the airport.
Despite my
I-
background, I
It's
apologize for
amazing
any
how
noise.
that park edge thing travels with you. You can put that in your background.
How you guys doing?
Good.
Good. Everyone's good.
Good.
Well, let's kick it off as usual. Let's just recap the October session. I think lots happened since then, and let's just kind of give an update of that and where we're going.
Sure. So one theme that we brought up this market insights for November is that as of the last FOMC meeting for the Federal Reserve, we thought there was a theme developing that Powell's flexibility meets limits, is how we titled it. And after weeks of speculation, what ends up happening at the last FOMC meeting is that the Fed chair turned incrementally hawkish and basically signaled, as he likes to do, that the Fed will stay data dependent until disinflation is clearly sustained. Meanwhile, the macro regime remains quad one with steady growth and resilient activity. Although we can maybe get into this with a shutdown, it's been tough with some of the data that we're used to getting not coming out. We also had the Treasury quarterly refunding announcement, otherwise known as the QRA, and that did reinforce our outlook for improving liquidity in 2026. And then also, there's been a lot of talk about the tariffs, the IEEPA tariffs, if they're going to hold, if the Supreme Court is going to rule those, that they can't be used. And so there's a lot going on, but that's an overview from last time.
Anything to add to that, Rich?
Yeah, the only thing I would add is that although the current regime is quad one, Goldilocks, which is risk on, the forward conditions look to be deteriorating some. And that would suggest that over the next 1 to 3 months, we might see a risk off move. And that is exacerbated by positioning that almost any metric we look at, people are overweight stocks. So if you get any disruption and people are underweight stocks, the market shakes that off. But if people are overweight and you get even a modest disruption, it could have an outsized impact. So I think that's probably what we're watching the most closely. I think when we get out into the first half of next year, we see growth picking up. We see a quad two on the horizon, which is also risk on. And the question is, are we going to hit a speed bump between, now and then? If someone has a long enough horizon, it's probably not something to get worked up with. But, in the case of Gavin and I, where we're trying to manage risk actively, that's, probably the number one thing we're focused on.
Well, good. That's a good update. And, the shutdown is kind of key point today that we're going to talk about. And it appears the shutdown is coming to an end, and all eyes will turn back to the Fed. We don't have Congress to worry about as much, at least until January, until they put another 60-day shutdown upon us or wherever they go from that. But Powell has been, has always preached data dependence, and we're going to react to the data. Since the shutdown, you don't have access to the data. Has that been in fact impactful? Do you think that's been impactful to where things could go, or are there missteps that could occur? How does that impact how we view things?
Yeah, well, if we back up, I think it was maybe 2 sessions ago, we came right out and said in the Market Insights piece that, the Fed is headed for its 5th policy mistake under Powell's tenure. They cut in September. and he talked dovish, and it looked like maybe they were going to avoid that. The key thing with the Fed is always by the time they see labor market weakness, it's typically too late. So if you take the business cycle and sequence it, housing is going to turn down early. New orders are going to turn down, then backlogs are going to turn down, then current production is going to turn down, corporate profits are going to turn down. The two most lagging variables in the entire business cycle are employment and uninflation, or employment and inflation. I'm sorry.
Inflation, yeah.
So the two most lagging variables are the two things that they themselves anchor on. So by the time it picks up in their models, it's often too late, which is why the Fed gets, the well-deserved reputation that they're always a day late and a dollar short. So
Yeah.
if we thought that they were headed for a policy mistake in September, they took one step to avoid it. Now, in the latest Fed meeting, Powell sounded hawkish. That has reduced the odds of a December cut, and that could be the catalyst for the speed bump. There's something in the forward conditions, what we call the weather conditions, that are saying we could see a risk-off, environment. Doesn't say how long it's going to last or anything like that, but it's just something to be mindful of. And if I had to pin it on one thing, it would be, the Fed, who is also late to the party. So when the economic data gets caught up, what if we see further weakness in labor? That just means they're lagged already.
Right,
And
right.
now you're adding more of a lag because they're getting the data late. And, that I think clearly is a risk factor.
That's interesting. Yeah, I mean, I think all of us are data dependent, but you're right. The Fed, who tends to lag, now you lose another month and a half, and who knows where that goes. What is your best guess
And
for
then
the
the other
Fed?
thing on top, not to interrupt, Todd, but the other
Yeah,
thing on top of that is, let's say that there's further weakness in it, and now they go back to cutting in December. How big of a cut is that going to be? And are they going to remain on an incremental path of 25 here, 25 there?
right.
When, if they're behind relative to labor conditions, they would have to do it aggressively. But stubborn inflation, which we've been talking about for 3 years now, is a constraining factor because you have voting members who are more concerned about inflation. And the Fed thinks that they need to have a consensus before they do something. If it were up to me, they would issue a report like the Supreme Court and say, here's the majority opinion of what we should do, and let other people who are voters criticize it and say, no, here's our position and why. That would be more informative for investors. But instead, we have to wonder what they're really thinking,
Yeah.
because when they come out with any official statement, they try to massage it into, some consensus opinion.
So with that in mind, and I think you've answered a little bit, but what is your best guess for December and maybe on into Powell's with us, through May. What do you think happens between, now and May as far as rate cuts?
Well, I'm mindful of, these weather conditions I mentioned. So, I would say that with positioning as offsides as it is now, that where is the firepower going to come from for a year-end rally or Santa Claus rally? So I think I would fade that, to the extent that, markets were expecting a year-end rally. I would probably take the other side of that until conditions change. And the whole part of our process, updating everything, every day, is we'll see it when they do change. But until they change, I think I would, take a more cautious approach between now and year end. And then when you get out to next year, economic growth is set to pick up. We're probably 100 basis points above the street in economic growth. So there's room for the street to take their estimates up. First half looks positive. Gavin mentioned liquidity picking up in the first half, growth picking up in the first half. You have tax cuts that are going to kick in, deregulation that's going to kick in. It's just is Mr. Market going to shake the tree and get the weak holders out first before we hit, that kind of environment? And as far as, at the end of Powell's term, I think behind the scenes, they're basically, doing the bidding of saying who could get the Fed funds rate down 200 basis points or 250 basis points, because the Treasury just has too much debt to sell. And, you're going to need the Fed to really, really drive down the Fed funds rate. And then the Treasury is going to issue bills and the Fed's going to buy them. I think
Yeah.
we're on record in earlier sessions this year saying we're going to get money printing again. The Fed's going to be the one to buy up the debt. Now, if the Treasury only issues T-bills and the Fed is buying T-bills, that's not going to be as disruptive as if the Treasury sells coupons.
Mhm.
So that could end up being a positive. But you have this K-shaped economy where the top 10%, the top quarter, the top half are doing okay, and the bottom half is not. I mean, their wages have not kept pace with inflation. If you're looking at cumulative inflation, housing is unaffordable for them. The average age of a first-time home buyer is at, record levels.
Right.
That's all fourth turning stuff. That means regime change at the Fed. And, we'll have to wait and see how that evolves when you get a new Fed chair. But the University of Michigan consumer confidence current conditions just hit an all-time low,
Mhm.
lower than 2008.
Wow.
So you have a stock market that is at the highs, and that's picking up a lot of small business where conditions are bad. And when you have a Treasury that borrows this much to deficit spend, it's crowding out all kinds of other potential borrowers, including first-time home buyers, including small business. And there's no will on either side of the aisle, the political aisle, to cut the spending necessary
Right.
to reduce the deficit. So again, fourth turning, viewers could go back to our fourth turning piece we sent out last month, to get a primer on that.
Well, that's good. Gavin, anything to add to that?
I would just cap it off and say, if we do get turbulence like Rich noted, maybe we will. If you look at, stocks off the lows from April, we haven't had a correction, so we would be long overdue. At Park Edge, we would welcome that, though, into what we're seeing ahead for next year and use it as an opportunity to position with some different themes and different ideas that we've been tracking. So I think at the end of the day, it would be an opportunity for us.
Well, good. That's a great update, and maybe we can buy some of those 50-year mortgage-backed securities that are going to be issued.
That's not one of the ideas.
That's not one of the ideas. So, well, great update, guys. Anything else to add from the team?
No, just happy Thanksgiving to everybody.
Yeah, happy Thanksgiving, everyone. Have a great holiday, and we'll check in December.
That's right. All
All
right.
right, sounds good.
Thanks, guys.
All right, take care.